ABC NewsRadio.
Brett Evans is the Managing Director of Atlas Wealth Management, which specialises in financial advice to Australian expats. And he has some interesting perspectives as to what's causing the wild swings on global markets. And Brett Evans joins me now. Good morning. Thank you for your time.
Good morning, Sandy.
First, is what we're seeing on global markets a correction, not a crisis, as Joe Hockey put it?
Look, I think Joe's correct in that. What we're seeing right now is when you see a correction, usually it's driven by a number of fundamentals. A crisis is more of a broad spread contagion effect that does tend to sweep financial markets, and we're not seeing that at the moment.
And one of the problems that you identify is that more and more people are investing in what's called ETFs, or futures contracts across an index. So basically betting on whether something like the Shanghai Composite will go up or down rather than looking at the fundamentals of individual companies. Does that just mean more volatility?
That's correct, because if you go back to old school fundamentals in the past, when clients picked portfolios or investment advisors or managers picked portfolios, what we tended to see was either a top-down or a bottom-up approach where they'll identify a sector that they're comfortable with, they'll identify the companies they're comfortable with and invest accordingly. These days, with the rise in popularity of exchange-traded funds, what we often see is people take blanket opinions on certain indexes or commodities. And what this means is when we do start to see a sell-off like we have seen recently, they don't tend to pick sectors that they're comfortable with and maintain exposure. They just sell the ETF across the board, which causes in turn the volatility in the index. So if you look at a number of key indicators that we look at in the States, the volumes in trading of ETFs, especially in the United States, has just gone up remarkably. Right now, investors have been trading about $18.2 trillion worth of ETFs. That's about 17% higher than 12 months prior, and more than more than triple what was 10 years ago. So, when you look at those sort of dollars, we're talking about a dollar term larger than the GDP of the United States economy.
Extraordinary. So does this all just lead to a vicious cycle, does it?
What it does tend to do is it tends to get a seesawing action, because what we find is it's a bit of a run for the door, then a run back in again. A rising and falling market doesn't rise and fall all stocks, and what we often caution clients about is trying to ignore the index itself and more so focus on company specifics and company metrics.
And I see you also say that we are really fundamentally misunderstanding the Chinese stock market. How so?
That's right. The Chinese market, up until only this week, was primarily being driven by mum and dad retail investors. In China, they have very few avenues of investing in terms of an outside market. So, with their capital constraints in place, they're primarily driven to investing in the Shanghai market. But what we often see is a herd mentality when it comes to their investment thesis or how they pick and buy shares. And what that does tend to do is it tends to exacerbate the volatility, because by nature of the mum and dad investor, they tend to be more emotionally attached to their investments. So when they're panicking quicker, as opposed to a professional investment manager who does tend to ride things out and doesn't have as much volatility in their investment decisions.
So what this means, do you say that the Chinese stock market doesn't necessarily reflect what's going on in the Chinese economy? That's
correct. Looking at some numbers from 2003 to 2006, when China's economy grew at a rate of greater than 10%, the Chinese stock market actually went backwards. So that to us is a key indicator that the Chinese stock market's not a very good bellwether as to how the Chinese economy is going. I think over time the Chinese stock market will mature with more governance, and also recently the Chinese pension funds have been allowed to invest into the Shanghai stock market, which up until recently wasn't the case. They were only able to invest in government bonds and cash. So what we're going to see is, a more professional approach to investing on the Shanghai market. If you look at the Hong Kong market, the H shares, which are virtually dual-listed Chinese shares, they're a lot less volatile. You can actually have the same share trading at half the value of what is trading in the Shanghai market. So I think we'll see a more mature approach over the coming years, but this is, any market that's developing like the Chinese stock market is, it does take time before a bit of commonality and a bit of common sense starts to come through.
So just finally and quickly, Brett Evans, looking ahead, when do you see this sort of volatility ending?
I think what we're going to see is a bit more of the seesawing approach. I've been schooling clients to say that just try and draw a line in the sand, pick some stocks based on some good fundamentals. I think what we've seen, and I've been in the industry for 19 years now, I haven't seen volatility like we've seen over the last couple of months, and it's very difficult to determine when the bottom is going to start to hit. I think we may see a bit more of action in the market for the time being, but I think more and more conversation coming out of Beijing will allay the market's fears, and I think that's when we'll start to see things settle down.
All right, Brett Evans, I'll leave it there. Many thanks for joining us this morning.
Great, thanks, Sandy.
Brett Evans there, the Managing Director of Atlas Wealth Management.
abc.net.au/newsradio. Get your news now.